We're joined by Harshvardhan Roongta, who's a CFP at Roongta Securities, joining us now. Harshvardhan, thank you so much for taking out the time. Festive season greetings to you and your family. My first question to you is, I was just telling the viewers that how commodities have seen a significant rally versus that of equities doing almost nothing. Just want to understand, is it now time to kind of change your expectations or change your perspective towards equities entering into 2026?
Well, Mahima, you've raised a very important point because we are at a juncture right now where in the last calendar year, or rather the current calendar, we're not still done with 2025. But if you look at the calendar 2025, the Sensex has given approximately 9.5% returns. A mid-cap index has given about 5.5%. A small cap index has given a negative 6.5%. Now, when you compare this kind of a 1 year return with what precious metals has done, so gold is up by about 80% and silver by about 145%. Now, what do you expect a retail investor to react? How do you expect the retail investor to react? So, most certainly, the retail investor is kind of disappointed with what kind of returns he or she has generated from the equity markets. Now, having understood this part, this is what has happened in the last 1 year. Now, what do you do with your portfolio going further? Now, that is the most important question. Now, if you observe investor behavior, even in the recent past, we will see that there has been a shift in the asset allocation. And rightly so. I wouldn't, say that what they have done is entirely wrong. Retail investors tend to behave in this manner, wherein if a particular asset class goes up in the recent past, they start putting in more money into the same asset class. So we saw this in the bull run of the equity market as well, when markets were at their peak. At their peak, in the retail investors look at the past returns, and then they pump in money at their peak. Now that possibly could be a trend that you're seeing in commodities right now, where you see that gold and silver has by far and by huge margin beaten the equity markets. So there is going to be a dilemma in the minds of investors as to what should be the approach for 2026. Very clearly, I would suggest, irrespective of what you see in the recent past, if your time horizon is at least 8 years or above, be very clear that your asset allocation plans cannot change purely because of something doing well in the last 1 year. So you change and tweak your asset allocation plan. That should not happen. That would probably be one of the mistakes that a retail investor would invariably keep repeating again and again. So to sum up in one line, just ensure that whatever asset allocation plan that you walk in with in 2026, that is well thought of, that is keeping in mind your risk profile, your time horizon, and your goals, not purely looking at something that has done well in the last 1 year. So let's just change everything around.
Harshvardhan, the other aspect is that, the way people invest also depends on their risk-taking appetite, right? A lot of young investors probably would have, gone ahead and invested in the mid-caps and the small caps. Small caps, in fact, have given negative returns, right? And same, if you take a look at how the Nifty Next 50 has done, it's not done anything in the past 1 year, right? So, considering all of these things, how should one go about in 2026? What should be one's focus area right now amongst these different baskets?
Mahima, you mentioned about people, taking more risk. Now, what's very important for any investor to do is to be very practical and realistic about their risk-taking appetite. Invariably, in a number of investors that we interact with, we will see that their risk appetite goes up when the markets are going up. So, because they don't estimate that what will happen in case of losses. Now, the classiest example is for investors who come into the market during the COVID period and post that. So from 2020, from the lows of the COVID bottoms that we had seen, markets had given one-way returns. You had seen only positive returns for a period of approximately four years. You had seen only positive returns. Now, what happened in this period? We saw so many new investors coming in, so many young investors coming in, first-time investors coming in, simply assuming that they can take a lot of risk. And that, confidence was coming into them only because they'd never seen markets reversing their trend or giving prolonged periods of no returns at all. So the confidence that investors get about their risk appetite is largely to do with how the markets are doing. So one thing that you need to be very careful about entering into 2026 is that be very realistic about your risk-taking capacity. markets can be, can actually be very painful for a prolonged period of time. It could give no returns for about 3 to 4 years. It could give negative returns thereafter. And then there'll be only 1 or 2 years where the entire market will, shoot up in such a way that the average of 10 years becomes about 12 to 15%. The question is who understands this cycle of the market, has the patience and the consistency to be into the market is going to be the winner at the end of it. So that's why I emphasize upon one point. If your time horizon is 8 years and above, do not tweak your asset allocation based on recent returns. Stick to equity, debt, precious metals in a ratio that matches you. So equity and debt will be purely based on your risk appetite, your time horizon, etc. The precious metals ideally should be approximately 10 to 15%, should not cross that much. But I'm sure, given what has happened in the recent past, I mean, people have tweaked their asset allocation to precious metals being more than 20 to 30% of your portfolio.
Okay, understood. But anything specific, Harshvardhan, that you would recommend our viewers out there to avoid doing right now? Apart from the fact that you did mention that do not alter your allocation of portfolio into different asset classes.
See, understand one thing very clearly. I mean, this is something that all investors should keep in mind. Every product, every asset class has its cycles. Okay, so when equity did extremely well from 2020 probably to 24, people started putting all their money into equity. Now, when precious metals are doing very well, we will see that people start removing money from equity, citing the fact that we've not earned any returns. It was better I would have put my money into fixed deposits. It was better I would have put my money into gold and silver. So this, looking at returns in the rear view mirror and then designing your future course of action is something that you must avoid for sure. Otherwise, you will never create wealth. You'll always be chasing that asset which has already run up. So it's like you're standing in a queue to buy a ticket, and there are two lines. There is one queue that keeps going very fast. So what you do is you jump and you walk into the other queue, only to realize that this one has now stopped and the other one has started walking very fast. So you'll have to understand that in hindsight everything looks different, but in future you have to stick to the principles, stick to the basics, understand your own risk profile. Do not simply mimic what your friend is doing because his or her appetite will be different, goals will be different. So be very realistic about who you are, what your risk profile is, and then walk into your financial plan. Do not simply mimic somebody. Do not look at the rear view mirror and plan your investments.
Harshvardhan, for somebody who is just starting to invest, in mutual funds or starting to do an SIP, what would your advice be in terms of building their portfolio, in terms of exposure to different asset classes, be it gold, silver, debt, or equity?
So, well, let's start with something that is an absolute clear answer. I mean, which is your commodities. So, the allocation should be around 10 to 15%. It should not be beyond that. And this 10 to 15%, the allocation that we're talking about, is excluding jewelry that you have for personal use. So, do not include the jewelry that you have for personal use for this allocation of 10 to 15%. Now, having one area already addressed, so which is 10 to 15% is into precious metals. Now, the balance amount has to be split between equity and debt. Now, equity and debt allocation depends entirely on time horizon and risk appetite. So, if somebody has a long-term horizon of at least 10 to 10 years, 8 to 10 years, then the allocation should be 70% equity and around 20% of the balance amount into debt. So, it will be, say, probably 60, 30, and 10. That will be your allocation 60% equity, 30% debt, and 10% commodities. If your time horizon is lower, you say that you need money in probably 2 years from now or 3 years from now, the equity and debt will be reversed. So equity would be 30%, debt would be 60%, and commodities, of course, remains at 10 to 15%. So that's how you will need to design your portfolio. That's how you will be able to create a portfolio or a diversified asset allocation plan, which does not really chase only the recent past returns.
And quickly, Harshvardhan, in terms of allocation in different market caps when it comes to equity, large cap, small cap, mid cap, how would you recommend a first-time investor to allocate his portfolio?
So, well, for a first-time investor, allocation should only be between large cap and mid caps. You don't need to really go to small caps. So you can simply restrict yourself between large cap, say 60%, and small cap 40%. So I think you're more or less done with this kind of, you have an exposure to the market of the top 250 companies. So that is good as an investment in your portfolio. If you would like to take a little more risk, you're a first time investor, remember that. But still, if you wish to take higher risk, then you can do a 50-50, 50% in large cap, 50% in mid caps. Avoid small caps if you're a beginner. And if you're a seasoned investor who understands market volatility and all the facets around it, then you can add some bit of small caps in your portfolio.
All right. Okay, Harshvardhan, thank you so much for getting us those details. And of course, I'm sure that our viewers now have a perspective as to what they're supposed to do entering into 2026 with their mutual funds and investments. So thank you so much for taking out the time and speaking with us at NDTV Profit. All right, viewers, with that, we're completely out of time on this edition of Your Money Matters. But do stay tuned. More news and updates lined up on the other side.